Accumulated amortization, the sum of prior amortization expense. This is a contra asset presented as a negative number, credit, in the assets section of the balance sheet. Accumulated amortization, much like accumulated depreciation, offsets intangible asset value recorded at cost under USA GAAP, such as patents, trademarks, copyrights, franchise licenses, and goodwill. Accumulated amortization, also known as accumulated amortization. This offsets the asset that is intangible and also allows for an amortization expense. Remember, we're learning the language of accounting here. So amortization is going to be like depreciation, which if is also unfamiliar, we'll give an example. Let's say we purchase for $10,000 a copyright. In fact, let's say this copyright was actually $15,000. Now, we don't just go off and create an expense for this patent because it is actually an asset on the onset. So we might have paid cash for this $15,000 asset, and now we have this patent. But we don't just go to our income statement or profit and loss and write that thing off. Instead, we want to take this over many, many years, depending on the rules, going down, amortizing, depreciating this intangible asset. Now, what the heck is intangible? You can't really touch it. It's not like a truck or a car. It's something a little bit more abstract, such as patent or a trademark. Or let's say you buy the local hamburger spot, hamburger place. Let's say you pay $1 million for it, but the actual land and all the value is only $100K. The $900K difference becomes an intangible value. You're buying things like the brand. You're buying things like customers. Alrighty? So, in a business purchase, intangible properties can occur. And that's what will probably happen for most people. It's not like we're all in the market to buy patents. Now, the patent makes it a little bit more straightforward. You buy this thing for $15,000, it's not just a straight write-off. So you have to guess or determine or really follow the rules as to how many years is this going to exist? How can we write this off over time? Not a GAAP methodology necessarily, but one that's also with government guidance. Maybe it's a tax methodology or whatever. Let's say just say 15 years is how long this $15,000 is going to last. So, every year, $1,000 is going to be the expense associated. The $15,000 here divided by the 15. These little 2's and 1's are just to try and connect the dots. Little CPA minship there. So we have this $15,000 intangible. We bought a patent, and every year it is going to be written off $1,000. Key here is accumulated amortization, though. What does that really mean? on the balance sheet, this patent is going to be an asset. So cash is going to initially go down, and when cash gets paid for this asset, or however it gets paid for, we will have intangible for $15,000. Now, every year, as we write off $1,000, or we have $1,000 expense on the year one income statement, we'll have $1,000 of intangible amortization expense. So we have this amortization expense for $1,000. Now we know in accounting everything has an equal and opposite effect across different accounts. Debits equal credits. So now $1,000 has been written off on the income statement. The other side of that will be the accumulated account, the accumulated amortization. In this case, I'm going to present it as a negative number, 1,000. So what this is really doing is allowing us to write off the 1,000, expense the 1,000 on the income statement, and on the balance sheet, the net amount, or cost minus the accumulated amortization, equals this 14,000. And this becomes the net book value, the net amount, and the amount remaining. This is at cost. This is largely theoretical. This intangible value could go up, up high, or down, down, down. If it's under GAAP methodology, maybe you write it off at a different pace. This is just strictly a theoretical, straight line, 15-year methodology. Every year, year one, year two, we'll have another $1,000. At year two, it would become $2,000, and the net asset value would become $13,000 in that case. So year by year, the amortization expense incurs, and let's say after 5 years, $5,000, we have $10,000 left, and here's the accumulated. Okay, so this is a regular asset increasing with a debit. All right, this is a debit increase. Now, because this is an opposite, it's a contra account. Go learn your debits and credits if you haven't already. Contra account. We are going to credit up. In essence, these are offsetting. These are polar opposite. One's that's a value in asset, and another thing that's reducing the asset to arrive at this $10,000 that's left. Largely theoretical placeholder, but what it allows you to do in the accounting record is making the expense. Now, finally, if this thing becomes worthless, this $10,000 would be completely written off. And if you sold it, let's say you sold it for $100,000 for the 100K, you would have the difference between this 10K and the 100, which would be 90. So accumulated amortization is just the accumulation of all these expenses that have been adding up on the income statement and is showing up on a contra asset on the balance sheet, just like accumulated depreciation. This has been accountingplay.com. Thanks.